Good morning, everybody. My name is Jeff Pollock. I'm the current Georgia CCIM chapter president. Appreciate y'all being here this morning. Just got a few announcements on behalf of the chapter. Certainly like to thank our sponsors. First and foremost, I'll list them for you and ask that y'all please keep them in mind in your business dealings. Marcus Millichap, Ackerman & Company, Adams Realtors, The Simpson Company, Wells Fargo, Standard Landscape, Brand Properties, Bank of North Georgia, Excelligent, Anderson Tate & Carr, First Colony Financial Corporation, and Strategic Exchange Advisors. So thank you guys very much. They allow us to have these programs at no cost and a number of other programs throughout the year. Speaking of which, we had a great social kind of happy hour event earlier this week at the First Citizens Bank over off Cumberland Parkway. Kind of a beautiful space overlooking the city and great networking and fellowship. So appreciate y'all being there, and thanks to Kim Rice who helped us put that together. A few additional announcements. Just a general note, whatever your day looks like, just be glad you're not in Denver right now taking your CCIM exam. There's 12 people from Atlanta or from the Georgia chapter that are doing that. So I saw some pictures on Facebook, people taking the course review. So for those of you that have been through that, it's kind of a grueling day. So hopefully your meetings won't be quite as stressful as a 4-hour exam. But speaking of the courses and the designation, our local chapter has scholarship money available, and the fourth quarter scholarship application deadline is November 15th. So if you're interested in applying for some scholarship money, please see Katie, our chapter administrator, Katie Centel, after the meeting, or ask me for her email address, and we can get an application to you. We have money available. We'd love to give it to folks to help them get those courses done. The chapter leadership rotates every year, and there was an email sent out to chapter members to vote on the next year's board of directors, the 3 executive positions. The deadline to vote is today, so if you don't have that email or need additional information on that, please let us know. Also, we're seeking committee volunteers for next year, so again, please see me or any board member or Katie to find out how to get more involved with the chapter. November 13th, we've got our economic forecast event. It's kind of our signature event of the year. We normally have north of several hundred people there. We've changed the venue this year. It's been at Villa Christine in the past, which is just around the corner. We're actually going to be at the Cherokee Town Club this year. We're excited about the new venue. And our speaker will be the same as last year, which is Dr. Sam Channon from the University of Pennsylvania, the Wharton School economics professor, and he's also got a consulting firm. Very well attended last year, very hot. The remarks were excellent. Everyone loved the presentation, so we'll have a great lunch, a good crowd, and some excellent information. So with that, I'm going to turn the program over to Michael Reeves, who's going to introduce our panel and our moderator. Thank you all for joining us. I'll let the experts have some time to share some wisdom with us. Thanks again.
Thank you, Jeff. Good morning. I'm really excited about our panel this morning and topic of valuations, art or math. I think it's been a topic that I've had a lot of colleagues ask us to do, and we haven't really done a topic like this since it's been a while, long time. So to my left is Ron Nahart. He's the Senior Managing Director of CBRE Valuations Department, and he's a Seminole. And to his left, Bram Morgan, founder and CEO of Brand Properties, a UVA Cavalier. And to our far left, we have Scott Kendall, Vice President of Commercial Real Estate and a Commercial Real Estate Specialist for Wells Fargo. So we have our appraiser, our developer, and our lender. And at the moderator stage, we have Mike Fasano. He is the Senior Regional Director of Marcus Millichap. And we are happy to have him here. He's been here not long. Got here in May from New York. So give him a round of applause. Thank you, Mike.
Okay. Good morning. We'll get right to it this morning, and we'll get started contextually with a little look back and where things have been and where maybe we'll get to where things are going. So for our panel, maybe we'll start with Ron. How have evaluations, and in your particular case, appraisals, affected the marketplace in the last 5 years?
Can y'all hear me without the mic or do I?
Yes.
All right, great.
No, you have to, sorry, Ron, you have to use the mic for the video.
Okay. It's interesting the last 5 years because I think there's always a tale of two cities depending upon the property type you're talking about, because the distressed properties, distressed being primarily occupancy challenged properties, really haven't changed too much over the last 5 years. Granted, cap rates have compressed, rental rates have increased a little bit, but your property that was 50% occupied 5 years ago and it's still 50%, it's going to be a challenge to see any sort of incremental increase in value. However, the other side, the Class A stuff, the net lease properties, multifamily, has benefited substantially. Compressed cap rates and increasing fundamentals, increasing NOI, lower cap rates, increase in value. So there's still, a couple different classes of properties out there that have benefited substantially while others have not and still remain challenged. And it's the appraiser's job to reflect the market. We don't make the market, so we reflect the actions of buyers and sellers. By that I mean, let's say, for example, use a extreme example that cap rates are 2% across the board and everybody's buying at 2%. Well, we know that's probably not sustainable, but to estimate market value today, if your property fits in that mode, it's a 2% cap rate. So keep in mind that it's our job to reflect the market, not make it.
Well, thanks for having me. My name's Brand Morgan. Like they said, Brand Properties. We're a developer. Haven't been doing much of that over the last 5 years. But to understand the last 5 years, you really got to look back 20 years. In 1994, banking regulation changed, which forced banks to not only set aside loan loss reserves, but actually charge against loan loss reserves, charge against their capital account due to the appraisers. So we have had, over the last 5 years, a real estate recession. A real estate recession has led to what is some people have called the greatest recession since the Great Depression. The real estate recession has caused our banks to enter into a crisis simply because of the regulation that was changed in 1994. I think we'd all agree that this is probably the worst real estate recession since 1994. So this is the first time this regulation has been seen in action with a fall in the real estate market. So let me stop right there and explain what I'm talking about. When you have a real estate loan that's $5 million, and in this market, let's call it an A&D loan for a local developer, and the market crashes like we have and it goes down to $2 million, that's a bad situation for the real estate developer, but it's a worse situation for the banking world. That $3 million deficit, they immediately have to take a hit to their capital. So let's just take round numbers. You got a $1 billion bank that has 50% of their loans in real estate A&D development possibly. I think we would all agree again that it's been much more than a 20% hit to values on real estate over the last 3 years. 20% on $500 million is $100 million of capital that the bank has to take a hit on. Well, guess what? The bank's out of business. 82 banks in the state of Georgia, at least last time I looked, had failed. I think it's probably increased since then. But we lead the nation in bank failures. And it's simply because, what I just ran through, the banks are running out of capital, not because they're running out of liquidity, but because the valuations, which Ron, he says, listen, don't shoot the gun at me. It's not my fault. I'm just reporting the market. But that's the fact of the matter is that's what's caused the banking crisis, which has then making the real estate crisis fall even deeper.
Scott?
I agree what he says. I don't really think I need to say anything else. He answered for me. We should just switch nameplates. No, it's certainly in my career, what's happened over the last, since we're using a 5-year snapshot, I can think of no other time that appraisals of in the banking business have had as much of an effect as they have. Absolutely for what Brand said, Wells is obviously a little bit different situation than the smaller community banks, but using the last 5 years, the reliance on appraisals as we mark to market and look at the assets and see what we need to charge off or reserve against it, strictly is coming off of the appraised value. So that's a lot of improvement over the last couple years. Is just kind of flushing out the appraisals from 5 years ago and renewing the appraisals as the properties improve in performance, and we start to do new loans.
Brand, from where we were, those dark days of 08 and 09, and where you sat as deals crossed your desk, how did you have to adjust your modeling, and were you surprised how accelerated it became as we moved from 2011 to 2012?
Let me take a stab at answering that. How did I change our model? We created a small fund to go chase distressed debt. The regulators were putting so much pressure on the banks to flush the system because, and I can't disagree with the logic, we are still having a hard time getting out of this recession because the banks are, especially the community banks, anything under $1 billion, are having a hard time lending money. Had the regulators not been tough on those banks and forced them to get the real estate loans off their books, we would still be in a deeper recession than we are today. So I didn't like it. We're in the banking business and the real estate business. It was a tough pill to swallow, but I think it was the right thing to do. So we changed our model totally. Our real estate investments looked at distressed debt regions, BB&T, Synovus. The community banks weren't necessarily a target because they didn't have liquidity. When they sold their debt, they didn't have the TARP money. So when they sold their debt, they went out of business. So there wasn't a ability to go to community banks and try to pick them off. A lot of people were trying to do that, and I told them it was a waste of their time. You got to go to the banks that had TARP, Synovus, BB&T, Regions, Wells, one really on the playing field until they came and took Wachovia, but there was an opportunity on the legacy assets from Wachovia. So moving forward, what am I doing now? We're trying to get back and do what we did in 2006, 7, and 8, which is develop, and we have 2 multifamily deals. Obviously, that's where the market is, and probably the only thing you can build speculatively right now. So we're focused on multifamily.
Okay, Scott, with multifamily leading the way out of the Great Recession, how did that affect the bank and how they were looking at multifamily that was accelerating pretty quickly, and the other assets were lagging significantly behind?
Well, we certainly, since I've been at Wells, the majority of the deals that come across my desk have been multifamily. The challenge there is because as that market is heated up, we've had to step back and say, okay, what are our underwriting criteria? You can certainly get caught up in the in the heat of the moment and start doing loans, and then you get to a point where we need to set some barriers of what we're comfortable with on a per door level. Where I sit in the business banking group. I'm not in the CRE shop, so it's been even more so as to let's define our credit box. Let's define our right customer for the business banking group, and let's don't get too crazy in multifamily, get caught in that wave, and then get too much of an exposure on the multifamily side. But certainly the majority of the deals that we've looked at the first 12 months as we've come out of the cycle has been multifamily.
Ron Branch spoke a little bit about what they were doing, trying to attack the distressed assets, still flushing through some of those assets today. How does that affect when you're looking at an appraisal of a stabilized asset, and yet in the same submarket, maybe there was 2 or 3 distressed assets that traded? How's that affecting you and how you do your work in trying to appraise the stabilized asset?
That's a great question because we battle that every day. And typically what we find is there's going to be a different buyer pool for that stabilized asset versus the challenged asset. So it's much easier to finance it, much easier to find a buyer for that stabilized property. Although sometimes the underwriting may be impacted a little bit, the underwriting being the biometrics, by the fact that it's in a neighborhood where there are a lot of distressed properties. So you have to look at the rent roll, you have to look at the turnover, the credits of those tenants, and it's going to be mitigated a little bit by the comparables. However, when you look at the sales, the appraiser has to be real careful that he's comparing apples to apples. In other words, he's looking at stabilized transactions and not the distressed sale assets. So you're comparing apples to apples, and that sometimes is up to the individual appraiser to make sure that you're using like assets. But by and large, there is a difference. It's up to the appraiser to make sure they understand that difference.
Let me think of one thing if I could grab it. We bought a note in 2011 for $100,000 an acre. Last month we got an appraisal from CBRE after we foreclosed out the note, cleaned up title for $330,000 an acre. So the point being is that CBRE understood that we bought a note, we had to work with the borrower on that. and get clean title. And so that comp, $100,000 acre was not a comp. There was a lot of risk associated with that purchase, but it shows you the improvement that's taken the real estate markets. I could buy a note for $100,000 an acre as raw land and then turn around, and we're actually developing a Hobby Lobby and a Carmack Cinema on it today. So the market, if there's any silver lining, is heading in the right direction.
Ron, how have things changed from being able to sit in front of the decision makers within the bank, albeit a committee, to tell the deal story, to tell the story about the sponsor of the deal, versus today, the impact that appraisals are having in that conversation when you're reviewing the loan?
Oh, I thought you said Ron, okay.
Sorry.
That's okay.
Scott.
You know, what really has been one of the biggest effects of what all banks went through in dealing with the regulators and how they look at our book is really the effect that we've had to have as we've dealt with the appraisers. I mean, at Wells Fargo, we have a totally separate group. They have all the communication with Ron. You know, the banker's not allowed to talk to the appraiser, nor really is the borrower. So I've got to rely, when I underwrite a deal, I've got to rely on the appraisal to come in. I sit down with my committee. You know, I can't speak to the appraisal because typically we're going to committee before the appraisal's even in. You know, we look at old appraisals and we talk about that market, but again, it goes back to what's happened over the last 5 years. I'm not sure values from 2008 really have. I can rely very much on those as I do deals now. But absolutely arm's length, no contact with the appraiser, and it's truly a third-party appraisal.
Ron, for you, speaking to the regulatory, how has the political and regulatory climate affected what you do on a day-in and day-out basis?
I think it's had a negative impact on appraisals overall because what Scott was saying is really true, and it hurts us as an appraiser trying to get us up to speed. If we don't have communication with the borrower or the broker or whoever's active in that marketplace, it takes us a lot more time to get up to speed. We like to hear both sides of it. We like to hear the good story, the bad story, and it's up to the appraiser to vet it out and make sure what's correct. So it's challenging for us. I think overall quality has declined because of the regulations where they keep it at arm's length, and it's gone to a kind of a low-fee win situation. For example, if I'm an expert in a particular property type, let's say golf courses, and I know golf courses better than anybody else, and you have a golf course deal and you send it to the bank, well, the bank doesn't necessarily relay that to the borrower. They just pick it based on the fee and the time frame. So you might get somebody that knows nothing about golf courses appraising a huge asset for you. That's kind of the unintended consequences of the regulations.
So the days of going to an appraiser who specializes in a given field isn't necessarily the person who's going to get the deal. They're going to go through a bid process, and oftentimes, correct me if I'm wrong, who submitted the lowest bid and who's got the quickest turnaround is going to get the deal.
You're correct. Now, there's some owners like Wells Fargo they understand that, and they'll give it to the specialty, and some of the other banks do too. But your smaller community banks that use the appraisal management companies out there, it's highly unlikely because they're just going to go with the low fee wins. And I see it about every month where the lender comes back and says, Ron, can you help fix this? Can you send comparables to this appraiser because he doesn't understand the marketplace? So you might win on the fee, but you might lose when it comes time for litigation or the ultimate loan sizing.
Brand, I see you nodding your head. Is there a story you'd like to tell there?
Well, Synovus financed our latest deal, and they sent me an email saying under box A, it's going to take 3 weeks and be $3,000. Under box B, it's going to be 4 weeks and $5,000, and that's all I got. And I got to pick which box I wanted to use for my appraisal.
I tell the story about being a commodity industry, which appraisal is not, because you think about it in your own personal lives. If you buy any commodity product, let's say aluminum foil from the grocery store, before you make that decision, you know who's behind box A and B. You don't necessarily know that with appraisal. So we're actually a lower class in the commodity product right now.
Scott, when you were looking at deals crossing your desk in, again, 2009, 2010, early 2011, I'm sure there was some trepidation as to the numbers that were being put in front of you, whether they were...
It was zero. We didn't do deals in 2009, 10, and 11.
There you go. There you go.
I was doing
I'm glad you're back in the game.
Yes, I was doing workout loans for commercial finance companies.
So when you look at the fundamentals today that are crossing your desk, is there more confidence in the bank as they're looking at them to say, okay, there's some stability here, there's some growth here, and we're on solid ground again?
Absolutely. And I've been with Wells a couple of years, and where we are today versus where we were when I started, it's night and day. You know, coming out of in January of 2012, while we said we were in business, I'm not sure we really were. We were trying to figure out what we wanted to do. But now, and a lot of it's driven by getting your credit officer comfortable in your committee, and they absolutely have a significant amount more positive feelings that, you know, there are loans out there that we can do. Not that there weren't good loans out and coming out in early 2012, but the confidence level certainly was a lot less.
Ron, following through on that, is it a little more straightforward and direct for you today as you're starting to look at some assets versus maybe 3 or 4 years ago when we were trying to put together a jigsaw puzzle?
It is. In our practice, we're seeing more and more assets that are stabilized. So we don't have to go through the lease-up scenario where you give an as-is and an as-stabilized. So, and that has to do probably with the financing, where most banks don't want to lend on a value-add type property. So maybe it's just our side is seeing more of the traditional stabilized assets. And like I said earlier, the fundamentals are strong. They've increased. The cap rates have compressed. So a lot of those deals make sense. The ones that are not stabilized is probably still challenging from a valuation perspective and probably from a lender's perspective as well.
Bran, when you begin to look forward, what would you forecast for the next 24 to 36 months?
Well, the Atlanta market's been always, or residential housing has always led us out of a recession. The challenge that we're going to have moving forward is that the banks under $1 billion were typically the ones that would finance the local A&D lot developer. Those banks are either failed or they're still in what I would call a distressed situation. They are not going to be financing that local developer. One, the local developer probably doesn't have enough cash in his checking account to pay for dinner. But the banks they're not financing the A&D loans, which typically had led us out of this recession. And so the Pulte and the Hortons and the guys, I'm working on a deal right now with Horton, they said, Bran, you know, we can't buy the land in the raw, develop the lots, put them into our engine and make the returns we need, because what's missing is the A&D guy who would go in there and develop the lot so they could immediately put it into their machine and crunch out houses. So what I'm forced to do now is go back to our lender on the raw land and say, listen, I need an A&D loan because I got to produce these lots for the developers. So when Horton looks at our site and says, I can't get that done, we're not, it doesn't give me a lot of confidence that we're going to be screaming out of this recession. But the most important thing we got to understand is that the community banks were the lifeline of the local developers, whether it was a small strip center guy or whether it was not a land investor wanted to buy 10 acres speculatively. Those loans are not getting done. Wells doesn't want those loans. RBC may want those loans, but they ran to the hills back to Canada, and PNC came down here. They don't want those loans. So we got SunTrust never made those loans. So we got a challenge, and it's called financing. We don't have the liquidity enter into the market to have us scream out of this recession.
Scott, what do you believe is going to be taking place in the next 3 years?
Oh, well, I certainly concur with what Bran said. The shop I'm in at Wells, we don't have an appetite to do any kind of A&D loan. Not to say, I do think at some point the larger banks, B of A, SunTrust, Wells, will start doing those again. Again, I'm in a little bit different type of shop at Wells than traditional CRE shop. You know, I'm much more positive now. And I think we're going to have the opportunity. There's a lot of pent-up capital out there. There's a lot of deals that are still being done. We're starting to see some single-tenant stuff, you know, becoming popular on top of the multifamily. Retail still lagging behind. I'm not sure I'm going to be doing many unanchored strip center loans in the near future. But over the next 3 years, I think we'll certainly be very, very active.
To that point, Ron, do you think that there could be a benefit, though, because we have not been able to, and not that there's been a need either, to develop new retail and to develop new office, that because that's lagging, it is giving those that have had some vacancy issues coming out of 08, 9, and 10 the opportunity to catch up and to restabilize. And so while Brand's right, you know, new construction always takes us out of a recession, there is an opportunity for those assets that have been struggling to get back up to the surface again.
Yeah, you're right, and we're starting to see that now because of the lack of new development. Occupancy are increasing. We're starting to see positive rent growth in primarily all sectors around Metro Atlanta, which we haven't seen in a while. And so you have rental rate growth, you have compressed cap rates and increased occupancy. So those are all good signs that we're seeing primarily in all property types. The wild card is what happens when the Fed stops tapering, because as we all know, financing drives real estate and real estate value. So without the liquidity out there to lend, we could find ourselves back in a recession here shortly without the Fed. You know, if the Fed stops tapering, the wild card about healthcare, we still have, you know, nominal job growth. So those three wild cards need to get some clarity in the marketplace so we can continue this brief bump up.
For everyone, maybe we'll start with Brand. If there's one or two things that you could recommend to the State House that they might be able to do to inject some momentum or energy into the marketplace, what might you recommend to them?
Get out of the way. You know, capitalism is a great thing, and sometimes I feel like Washington isn't pushing us in that direction. So get out of the way, and we can make some money.
I agree. I mean, I think they tend to err so far on the side of over-regulation. Not that that's not necessarily a bad thing in a lot of cases, but we talked earlier about the over-regulation of how we deal with the appraisers. I mean, that's the kind of stuff that does take the art out of it and does make it a lot more difficult.
I would agree also, and probably a sidebar, you know, years ago we used to write our reports to meet rating agency scrutiny on the CMBS side. Now we kind of write it for litigation. We want to make sure that it supports itself in court, and that's kind of a different tact of ours. Not that it impacts value, but it just impacts the way we look at things.
One thing on the banking regulation, the regulations that the government's putting on banks these days forces you to have a critical mass. So the community banks that were $300 million and below simply can't have the paperwork and perform at the level that the government's making the level, so they're not going to exist anymore. That's not what we've had from the 1980s through 2006. So I think we're going to see less community banks. If you had $10 million and you know, a guy that was vice president at Wachovia at the time, you could start a community bank in Georgia. That's not the case anymore because literally the red tape and all the regulations, you can't afford. You're not making enough money to produce the documents that the regulators need. So I think we're going to have fewer community banks in Georgia. The 82 or 87 that have failed aren't going to be coming back, and therefore I think, again, you're going to have less liquidity coming into the market.
Why don't we open up to the audience some questions for the panel? Yes, sir.
As a broker, appraisals can be frustrating. I sold not long ago an REO property. The first appraisal, it was the note was bought by a group in Chicago, and the appraiser they got was from the very northern reaches of Atlanta, and I'm not sure he came down to get it. I offered to tour around the property and do that, and he says, no, I can handle that. And he came up what was in effect $150,000 too high in a property that was worth $700,000. And it took an extra year to sell the property because going down through the steps of reducing amount on the loan was crazy. The second appraisal was by a fellow that was also from a bit out of town, but he said, let's spend a day together down there. So we looked at the submarket, we looked at what you could lease it for, we compared leases, we did all that together, and he ended up writing a pretty good appraisal, but, I mean, a pretty accurate one. But it can be a disaster to the holder of the note, to the broker that's trying to work on it, when someone just gets on the computer and says, well, how many buildings were this many square feet in this area sold, what do those work? So how can we end up with an appropriate appraiser who does appropriate work on a site? Because the guys in Chicago would have no idea how to fix somebody.
It's a challenging question because you really don't know who hires the appraiser first off. But let's say you don't have any input in that and the appraiser calls you. What I would suggest, if you have that opportunity to meet with the appraiser, strongly suggest the meeting. Actually send him some comparables that you know of. Give him your take of the marketplace, whether it's good or bad. Try to educate him, especially he's from out of town, which is a shame on the client for doing that. But let's say he's from out of town. Get him up to speed as much as you can and give him all the information that you have and then hope for the best. But
I did that with the first one. And he just thanked me. And nothing of what I said reflected in his appraisal. And I'm sure he did a legitimate appraisal, primarily by computer. But it just seems to me that the appraisals, whether they're too low or too high, end up really, from a broker's point of view, bollocksing up the transaction.
yeah, I was going to say also if you get a copy of the report to review it, so you can see how the appraiser came up with his value. Maybe after you look at that, maybe you still disagree, but maybe you might agree. So if you get a copy of that, then you have some ammunition to go back to the appraiser and say, I think you missed it here, here, and here. Can you take another look?
Well, you're spot on. I think I led the panel discussion with trying to explain how important and really vital the appraisals have been to this recession. Whether or not, like I said, the appraisals led to a lot of the bank failures, quite frankly. Coming out of the recession, the appraisal has such an important role in whether a transaction takes place or not. On the borrower side, because I was in the real estate business in 2005 and 6, and so therefore I had debt on development deals in 9, 10, and 11. Every time I had a loan mature, I called the bank and said, all right, I want to get 3 appraisers. They're like, what? You want to get 3 appraisers? I mean, that's maybe you're going to pay 3 times the cost. No offense, I had no confidence that any appraiser was going to get the right number. And so the bank, in most of the situations, the bank didn't want to write down the loan for other reasons I've talked about. So they said, sure, if you're willing to pay for it, we'll do it. Well, guess what? 3 appraisers, probably ranging from, let's say it's a $100,000 note. I'd have an appraisal come in at 110, 95, and 50. Well, what would happen if I didn't get 3 appraisers and only the 50 came in? I'd be in a terrible situation. The banker wants the note to reappraise, wants to renew it for me because I'm a good customer. He's in the production business. So we picked the 110 and said everything's dandy. All right. On the flip side, I was out there buying notes. And so I called the bank and said, well, here's the value. Your property's worth, again, $100,000. He goes, well, we got a $150,000 appraisal in the file. I said, all right, let's go to the next deal. This property's worth $200,000. He goes, well, we have $150,000. I go, I like it. I'll buy it. That's the way we did our business.
A lot of times based on that, you really have to understand the scope of work that the client imposes on the appraisers, because you could have the same property and one appraiser says it's a 9 cap, one will say it's a 10 cap. They both could be correct depending upon who they talk to and the information they get from their client. It could be based on the property rights they're appraising. One could be leased fee, one could be fee simple. So a lot of times that explains the wide variances in the value. So you really have to make sure that the appraisers are appraising to the scope that is appropriate for that particular client.
Aftermath of those circumstances, my experience has been once the appraisal is issued, it's like it's out there. And then if there is an opportunity to amend or adjust, then that's great. But I haven't really seen that as much. Where the bank says, hey, we got this number, sorry. And then the developer, the owner has to either come up with more equity or math.
In there, you're right, except that if we challenge certain elements of the appraisal, the bank will reconsider, but they're going to require the borrower pay for another appraisal. And so they're putting the onus on the borrower. And there's been a number of circumstances where it's worked out just fine. It can be frustrating for sure, no doubt, but there are ways to work through it if you have the bank who's interested in making it work. But the reason they're requesting the other appraisal is because of regulation. They got to paper the file to make sure when the auditor comes in that CYA is taken care of.
It used to be we could send draft reports to the clients, especially the banks. And now with the new regulations, they've stopped that, so we have to send a final document. However, most banks will allow, if the borrower doesn't agree, to go back to the bank and have us reconsider. Let's say we missed information or we didn't have the accurate information, to go back and revise that. We don't necessarily charge for a new report, but we'll just amend the report and send it. However, with litigation, once you send that final document and then you revise it, the attorneys get the email chain and say, well, wait a second, you were pressured to change this. So there's a lot of that going on, depending upon, the use of the report. It's for litigation, we're probably not as willing to change it as much as it was for normal financing.
Sir.
This question really for Ron. As commercial brokers, I know that in the appraisal industry, and I'm an appraiser as well, what is the biggest challenge that you have? My opinion is it's lack of information, credible information, because it's very hard to get lease rates and so forth. How do you combat that challenge?
What we do at CBRE, obviously we look at historical transactions from that perspective, but we try to bring it current. And the way we bring it current is we survey what we call market participants in the report. And market participants are y'all, brokers, developers, anybody that's active in that particular field, and we'll ping you for questions. It could be the lease rate. It could be cap rate. It could be whatever the particular that property, to try to help the appraiser be more current in that marketplace. So when appraisers call you, please give them all that you know, because that's the only way we can help bridge the gap between the historical transactions and what's going on in the current marketplace. So we value your input, and I know my staff's calling brokers all the time to get their opinion on various topics.
Ed?
Not change the price of an appraisal property every 3 months, if something new is, they change it every 3 months, or they can't change it until they get a new rate, review that every 3 months.
Say that, I'm sorry. Repeat that.
If the bank gets an appraisal of this property at the appraisal price, they can't really negotiate that price until they get another appraisal.
You're talking about the REOs from an REO side? Yeah, I think you're right. I don't deal in REOs at all. That's a whole different group.
Yeah, on the regulation side, every year you have to have a new appraisal. So
yeah.
If you get a good appraisal and you're a bank, you may want to, make that 13, 14 months, because you're scared of going to get another appraisal. So you get your hand slapped if it's over a year old. I think, but again,
Yeah.
Synovus, who every quarter resets their book, they may do it every 3 months.
Challenging parts about the appraisal business itself, where the clients ask us for a point and value number, and we're not that good. It could range 10–15%. So if I was ruling the world, I would say for the lenders, if it's an REO situation, have the appraisers provide a range and not just a pinpoint value that we're tied to. It would make life a lot easier for everybody.
Other questions?
The reason I was laughing, I said, well, you give them a range of values, the regulators are picking the low one.
But they don't. They require a point value.
Ron, directed to you and Brand also, what is most of the banks that failed, or majority failed in 9 and 10, some at 11, but a lot in 9 and 10. We're coming up on 14 and 15, which is the 5-year trigger for the loss share agreements. An idea of what do you think that's going to do to the market value?
We're sitting on dry powder. We think it's going to have a big impact on the market. There's no reason for that loss share bank to take the risk of not having a backstop by the federal government and let the loss share expire. So, I mean, Georgian Bank failed, probably one of the larger banks in Georgia that failed. First Citizens, first of all, they don't want to be in the real estate business in Georgia, so they've been fire sailing everything. But I guarantee you, even their good customers, come 5-year reunion of that loss share, they are going to flush the toilet and get rid of those loans. So hopefully, you know, the market's going to be strong enough for that borrower to go out there and refinance with someone else. If they're not, it's going to be a tough situation.
Yeah, not only do you have that, but starting late 14, 15, 16, and 17, you're going to have the largest wave of CMBS maturities come to the marketplace, and something has to happen with those loans where the property sells, they refinance, there's some sort of transaction that has to be involved in those properties. So who knows what's going to happen with all those CMBS loans.
There's a lot of dry powder that was raised to chase distressed debt that has not been put out. So not a good thing, but there'll be plenty of people there ready to buy those CMBS notes if they can't get renewed. So that's not a good thing for us in Atlanta, but I think it's reality.
Anyone else? Yes.
Scott, what kind of deals are you looking for? You're not doing brokering, you have unanchored retail. What kind of deals, part of the discussion this morning is kind of the art of the deal. What are some deals that are doable and that would be appealing to you or others?
Absolutely, Jeff. Good question. Again, I sit in the Atlanta business banking shop. I'm not in a traditional CRE shop. So for us, I strictly do investment real estate, and I always call it the major food group kind of stuff. It is the multifamily, the single tenant and multi-tenant office, single tenant retail, not nearly as much unanchored retail. Industrial, so really the major food group, really no special purpose. We're confident, but we're not nearly that confident. But it is the major stuff.
Let me jump in here as the broker. We're pretty confident. June and July we closed 73 transactions, more than a deal a day. August was impacted by the little whisper that came out of Bernanke's office about potential tapering, and we saw rates move 100 basis points. So August got impacted by that. But September, we put another 30 deals under contract. October, we're going to break 30 deals under contract. So when you look at the quality of the deals that we're working with, they're all B and C assets, $1 to $20 million, and multifamily leading the way. But the specialty products are doing just fine. Self-storage, hotels, mobile home parks. In addition, the single-tenant net leased assets, everyone and anybody that's out there who's coming out of an asset is looking to add that to their portfolio. And these are not leveraged deals. These are all cash. Someone said it earlier. There's a lot of equity sitting on the sidelines. They're deploying it into single-tenant net leased assets. So when we look at areas that could still improve some more, sure, multi-tenant retail can improve some more. If you've got Publix in there, you're going to do just fine. But anything short of that, you know, you're still working in the mid-8s to the low 9s in cap rate. And suburban office, if you're not in and around the perimeter, you're in and around Buckhead, you still got some issues to deal with. But by and large, 13 has been a significant move away from 2011 and 2012, and we're pretty positive and pretty confident about moving forward. Anyone else? Yes, sir.
Comment on one question on your are you talking in the greater metropolitan Atlanta area, or how big are those ones?
It's the region. It's Georgia into Alabama, South Carolina, the Panhandle, and into Chattanooga.
All the air out of the room, but I'm a developer, so I'm pessimistic sometimes on the liquidity in the market overall. If you're not a developer and just in the real estate business, I'm much more optimistic.
Okay, thank you.
Again, thank you all for coming, and we'll see you hopefully on the 13th at our economic forecast. Thank you to our panelists. Appreciate it.